Sentiment is mixed on mixed economic data and on political discussions on both sides of the Atlantic Ocean. The euro is under pressure before the election weekend in France. The US dollar is better a bit thanks to Donald Trump, while investors keep an eye on inflation figures in the US and in the Eurozone as well before the weekly closing bell. So welcome and happy Friday. This is Swissquote's Daily Market Talk. So sentiment yesterday was mixed on a series of mixed economic and corporate news. In Europe, the business and consumer survey came in slightly lower than expected by analysts. The French CAC 40 lost more than 1%. The STOXX 600 fell as well. The German stocks, however, did better than their European peers yesterday, as some big German names like Siemens and SAP performed well, while in the UK, the FTSE 100 index sank below its 50-day moving average, and that despite a softer British pound and a positive breakout that we saw in oil prices. So the US crude finally cleared the critical $82 per barrel resistance and returned to the positive trend that was building at the start of this year. So the April to June sell-off that we saw in oil prices is fully behind us now. Trend and momentum indicators remain positive and supportive, while the market is not yet in the overbought territory. So all this means that there is room for further gains in oil prices in the short run. So from a technical perspective, the outlook has improved. Now, from a fundamental point of view, we have some supportive and encouraging news as well, because yesterday's GDP update from the US confirmed that the US economy slowed in the first quarter of this year, or the growth in US economy slowed in the first quarter to just 1.4%, but the print was slightly better than the 1.3% expected and well below the 3.4% printed a quarter earlier. Sales and consumer spending held, inventories rose, and price indications were not enchanting as it was expected, but investors actually looked past these components, the inflation components, as the uptick that we saw in inflation in the first quarter of this year is thought to have slowed past the first quarter. So other than that, the US trade deficit widened to the highest levels in 2 years. Pending home sales fell 2%, and the jobless claims rose to the highest levels since last summer. So overall, the economic data released yesterday in the US hinted at further slowdown in the US economy, but the slowdown, didn't look catastrophic. As such, the data fueled the dovish Federal Reserve expectations and hence boosted appetite for the US Treasuries, along with a strong sale of 7-year bonds yesterday, following good sales of 2- and 5-year bonds earlier in the week as well, remember. So the US 2-year yield tested but remained above the 4.70% level. The 10-year yield fluctuated near the 4.30% level. The S&P 500 and Nasdaq 100 eked out small gains as the Fed rate cutting hopes rose yesterday with the data, with some people expecting up to 2 interest rate cuts from the US from now to the end of the year, and the US dollar eased. But the US dollar rebounded in Asia in between, because the cherry on top of all this, because wait, I haven't spit the best just yet. The US dollar and the futures rose, and they're in the positive at the time I'm talking here this morning, because yesterday's debate between Joe Biden and Donald Trump, that I couldn't watch obviously because I was just sleeping, but that debate apparently went better for Donald Trump than for Joe Biden. Because the first news I saw this morning when I opened my eyes was on Bloomberg, Biden falters against Trump. Among the key takeaways, CNN cited his rough voice, so the rough voice of Biden, halting responses and confusion over key economic data, and even Biden's incoherence in his prepared closing remarks. Well, with all due respect, Joe Biden is born in 1942, so during the Second World War. He might be great, but he's old, he's perhaps too old to rule the world. Trump, on the other hand, he's just Trump. He's not young either. He's not your regular US president either. I really enjoyed, by the way, preparing my morning reports when Donald Trump was president and he was at office. It was so much fun, obviously, time to time absurd, but investors clearly prefer him regardless, of course, because, he's a businessman and he's Trump. He's just Trump. And the S&P 500 gained 67% during the years Trump was at office versus just 44% under Joe Biden. So investors are happier to see Donald Trump do better than Joe Biden do better. In all cases, the US debt will continue to explode, obviously. Tensions with China will also probably get worse. And, the US economy could, get softer before it gets stronger. But this is what we, or the central bank, wants for inflation. So there is one more thing that we should watch before this week ends, and that's the core PCE data from the US, which is the Federal Reserve's favorite gauge of inflation that is expected to show further weakness in both headline and core figures when it's released today. So if that's the case, combined with yesterday's softish growth data from the US, we could see the Federal Reserve those remain in charge of this market. And the latter could obviously help broaden the US stock rally to non-technology sectors and toward the reflation-friendly European markets as well, even though the European stock market should first obviously shake off the election jitters off its shoulders, especially in France, and I'll show encouraging metrics as well to keep the European Central Bank rate cut expectations well alive and supportive of the market. So this brings me back to Europe, where some Eurozone countries will be revealing their preliminary inflation numbers for June today. So sufficiently soft inflation data is needed to keep the European Central Bank those alive. But for the euro, the upcoming French election this weekend is probably more important for investors than the inflation figures themselves, regardless of the data, unless we see something very big in the economic data, which is not expected, by the way. Many investors will probably choose and feel comfortable to go into the first round of election weekend in France without a positive exposure to the euro, given that Marine Le Pen's national rally is seen securing 1 vote out of 3 this weekend, and that's not the outcome that the market is necessarily happy with. And we can see it in the spread. The spread between the French and German 10-year yield is back above 80 basis points and could further widen, obviously, depending on the French election results, the French election outcome this weekend. And higher yield differential means lower appetite for euro, mind you. But it could also be that a blow to Macron has already been priced in, and maybe even overly priced in which case we could see the euro rebound in a typical buy the rumor, sell the fact move on Monday. But volatility will probably be on the menu on Monday, and the euro could, regardless of the inflation figures on both sides of the Atlantic Ocean, further ease against the greenback before the weekly closing bell today. The euro dollar currently trades below the 107 mark this morning. We could see the pair fall below the 106.60 level, a level that acted as a support since Emmanuel Macron called the snap election. And a last word for the yen for this week. Dollar yen was trading past the 161 level this morning with no particular news of intervention from the Japanese authorities on the wire just yet. But the yen bears are looking for the limit. Where is the limit? While the risk of a direct FX intervention grows with every pip that we see higher in the dollar yen. So this is all for this week. This is all for this quarter and for this half of the year. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading.